Welcome to CFTC Talks. I'm your host, Andy Bush. You can subscribe to the podcast by going to iTunes and searching for CFTC Talks, or you can listen to the podcast by going on our website, cftc.gov, and click on the podcast button. By the way, there's an important disclaimer at the end of the podcast you should hear. This week, we dive into the markets. Remember, our goal is to learn about market dynamics, liquidity, and fragmentation. We're also trying to understand, what's driving the markets. And to do that, we need to understand the narrative that is currently driving values. To this end, we begin the information gathering by turning to someone who has been involved in the markets for over 30 years. Sam Stovall is the Chief Investment Strategist of U.S. Equity Strategy for CFRA, formerly S&P Capital IQ. He serves as an analyst, publisher, and communicator of S&P outlooks for the economy, markets, and sectors. Mr. Stovall is also an author of books on the markets, including The Standard & Poor's Guide to Sector Investing and The 7 Rules of Wall Street. Sam, welcome to CFTC Talks.
Andy, it's always good to talk to you.
Thank you so much for coming on. This is great. Hey, we live in interesting times, don't we, Sam? And from your perch, what do you see are the top 3 narratives that are driving the markets today?
Well, Andy, I think that they're very simply inflation, earnings, and alternatives. Basically, when you think about how low inflation is today, right now we are in the bottom quintile of inflation since World War II, meaning in the bottom 20% of all quarters since World War II when you're looking at headline CPI on a year-over-year basis. That is what is causing the Fed to keep interest rates so low, and whenever you have low interest rates, that tends to be positive for the stock performance of the global as well as U.S. stock market. The second item is earnings. We have been seeing earnings beat the estimates found in the beginning of each quarter in each of the last 21 quarters. So meaning the end of quarter actual results ended up being much better than the beginning of quarter estimates in each of the last 21 quarters. And the magnitude of outperformance has been between 3 and 4 percentage points. So the implication is that in this second quarter reporting period, rather than getting the 6% growth that was expected at the beginning of the quarter, now we're probably going to see something closer to 9 or 10%. And then finally, as a result of inflation being this low and earnings being this good, investors are sounding an awful lot like Richard Gere in the movie Officer and a Gentleman when he wailed, "I got nowhere else to go."
Oh, jeez.
Because basically there are a lack of attractive alternatives out there. Who wants to own 10-year bonds yielding less than 0.25% more than stocks when stocks give you essentially the same income, but you have greater growth potential with equities in the year ahead?
Yeah, certainly that has been the challenge ever since these central banks, these global central banks, went on the tear of increasing their quantitative easing and accumulating the assets. And, for a long time, the equity and bond markets have really benefited from low interest rates. So I guess the question back to you, Sam, is this, given that the Fed, the ECB, and the Bank of Japan are all discussing what to do with their balance sheets and quantitative easing overall, is the market concerned about that synchronicity of monetary policy tightening? I mean, to put another way, are all these central banks, in the process of taking the party bowl away on monetary policy?
Yes, they are, but they're doing so in a very different way from the past. They were doing so with an amazing amount of transparency and lead time. Let's focus on the U.S. Central Bank first, because I think most people can appreciate that. Several years ago, when Ben Bernanke was Fed chair, he essentially said, look, the central bank is going to be the surrogate consumer for a little while, that essentially, in order to prop up the economy, prop up interest rates, etc., as well as stimulate demand, central banks will then be lowering interest rates in order to stimulate economic growth. So we went down essentially to 0% interest rates. But he said, just as bombing alone can't win a world war, you've got to have ground troops as well. You can't use monetary policy or interest rates in isolation. You also have to have fiscal policy, or Congress actually engage in some sort of stimulative legislation that will help the economy to grow. Well, unfortunately, unfortunately, Congress is doing what it's always done, and that's why it earned the old adage that if the opposite of pro is con, then the opposite of progress is Congress. So essentially what we're finding is that, okay, the Fed really has to say, you know what, we've gone long and far enough with interest rates. We have to start refilling our, backpack, if you will, of arrows in order to fight the next recession.
Sure.
So yes, we've had 3 interest rate increases over the past several years, but we are still in an incredibly stimulative environment because normally the difference between the Fed funds rate and the year-over-year percent change in CPI has been about 1.5 points, meaning that if inflation is about 2% now, then the Fed funds rate should be at 3.5%, not at 1%. Mm-hmm. So until we get up to an inflationary neutral kind of an environment, meaning Fed funds rate equals the year-over-year change in inflation, we're still going to be in a stimulative environment, but the Fed realizes it can't do this forever.
I'm going to say, in fairness to Congress, they did spend $900 billion back in 2009, but let's not get into that. But let's talk about the current Congress, because I think this is important for the markets. How critical is tax reform? I know we've not been able to kind of get the healthcare reform that many people wanted, but on tax reform, how important is that for the markets?
I think it would be icing on the cake, but it's not something that has to be done. What I mean by that is we are actually seeing an organic growth in the U.S. economy, the global economy, as well as corporate earnings. Corporate earnings are expected to be up more than 10% this year. Nearly 12% is the expectation for 2018. We're seeing economic growth that is likely to hit 2.7% year on year by the end of this year, and looking at an equivalent near 3% growth rate by the end of 2018. So if we do end up seeing a tax cut, that'll be gravy on top of this, because S&P Capital IQ published an estimate a little while ago that basically said for every 1 percentage point reduction in the tax rate, that would equate to about a 1 percentage point increase in corporate profits. So if the tax rate goes from the stated 35% down to 25%, then that would add about 10 percentage points to the growth in earnings in 2018, and therefore pushes up from a near 10% to about 20%. And that would be very good, but it's not something that has to be done in order for this bull market to stay alive.
Well, Sam, let me push back just a little bit, because don't you think that the market's pricing in some kind of rate cut already when it comes to tax reform?
They might be doing so in their whisper mindset,
right,
but not in their matrices as to where earnings will be from now.
Oh, I see what you're saying. So the analysts haven't priced it in yet. The market narrative of what's swirling around in the emotions of this beast that's out there called the market narrative, that may have it. But as far as the analysts go, what you're saying is that that's not priced in yet.
That's correct.
Okay.
So that investors are basically saying, look, do I really want to be bailing out of stocks if there is still the potential that we could have tax cuts? Now, I'm emphasizing tax cuts, not tax reform, because I think there's too much division, not only between Republicans and Democrats, but also amongst the Republicans themselves, to actually agree on what kind of reform there will be. So if we simply reduce the tax rate and not worry about adding to the deficit because we make it last less than 10 years, then we would still have that icing on the cake that could end up being a little easier to pass.
Right.
So, but because there are no specifics as to what this tax cut would look like, analysts are basically saying, well, we can't just put in pie in the sky into our formulas and have anybody believe us.
No, I totally understand that. One of the things that they can and have done and started that process already, unlike tax reform, is regulatory reform. How does that come into play for analysts, for the market, when you're looking at the things that have already been either discussed from the federal government, from the Trump administration, and from the Treasury's report on regulatory reform, to the ones that have already started to take place? I mean, how does that factor into what these analysts and what the market's talking about?
Well, I think it can be seen probably best in the bank stocks themselves. Banks in this second quarter reporting period have all beaten the bottom line, meaning they've all done better than the expectations for earnings, but have not beaten on the top line or the revenue area, mainly because they've stumbled with trading. One reason is because this time last year you had a lot of trading take place after it was voted that Britain would leave the EU. So the Brexit velocity is good for traders. It's like surfers. If there are no waves out there, well, then why bother going out? So this time we've had an incredibly low volatile environment, which has done nothing for traders. Yet I think that because we've seen an improvement in corporate earnings, because earnings outlook not only for the banks but also the financials in general has gone from 7.5% to more than 9% for the second quarter, we're actually seeing an improvement in earnings that, again, it affects the mindset where, gee, if regulatory burdens are going to be lifted or at least eased for the financial community, then that would imply that forward earnings could be even better.
I see. That's interesting. Let me come back to something that you talked about with low volatility in just a second, because I want to get to where you see economic growth for the second quarter and the third quarter. I think if I heard you correctly, this quarter should be somewhere around 2%. And then what are you expecting for third quarter?
Well, essentially what we're looking for is the CPI to be up about 2.7% by the end of this year.
Okay.
So that gives us, a good idea as to what is our target overall. But when we look at it quarter by quarter, GDP was up 1.4% in the first quarter of this year. Then we're looking for the 2.6% number for the second quarter, 3.1% for the third quarter. So actually averaging out, we're going to be seeing an improvement, and then coming into about 2.8%, 2.9% toward the middle of next year. So we're still in the terrible twos, as I like to call it, but at least it's a lot better than the sub 1.5% that we've been experiencing over the past many quarters.
Yeah, and with that backdrop for stocks, you make the point in some of the research that you've done that history says that this year's 25th new high should be cheered and not feared. Why do you say that? I mean, normally, when you have that many highs, it seems like the market may be bubbling a bit. And you make the case that that's not what's happening now. Why do you make that case? Why do you think that's happening?
One reason is mainly I like to go back to history. I think history is a great guide. Obviously, it's never gospel. It's a good starting point. And so you ask yourself, well, okay, let's put things into perspective. So through July 14th, we had 25 new highs for this year. Well, if that was a full 12-month number, that would place us only number 20 since World War II. We had as many as 77 all-time highs in 1995. Wow. Even if we doubled that 25 and we said, okay, well, we have 50 for all of 2017, that would still place us in fifth place behind 95, 1964, 2014, 1961. So it doesn't all come from that concentrated tech bubble that occurred in the latter part of the 1990s. Also, when you think, what about the fact that we have had 151 new highs in this bull market? That's got to be a record, right?
Sure.
Survey says we had 308 all-time highs in the bull market that ended in 2000. We had 152 back in the bull market that ended in 1987. So, we're actually only number 3 in this category. And when you look at the actual number of trading days that were in all-time high territory, we've had 8%.
Wow.
Yet in the bull market that ended in 66 and the bull market that ended in 2000, they had 13% of trading days. So what it basically says is, history says don't count us out just yet. We could have many more days in new high territory. And then finally, I looked back and I said, whenever we do hit a new high, what happens 3 and 6 months down the road And while the average price change has essentially been the same as during all periods, the batting average, or frequency with which the market rose, was actually better, to the point we were up 75% of the time 6 months after hitting a new all-time high.
Well, let me shift gears just a little bit away from the equities. And, well, I mean, it's all kind of, they're all impacted by similar things. But you had mentioned CPI. And one of the things that's obviously driving CPI, of course, is commodities. And we're talking about oil and grains and a whole bunch of things. I mean, how do low commodity prices come into the picture for your outlook? Because we've been experiencing that for some time. We know that year-over-year comparisons, certainly with what's happened in the energy space, are very favorable because they were so bad the previous year. But we're also seeing, in the space that the CFTC covers, obviously in the markets we look at, it's a wide range of commodities going from energy to grains to you name it, pretty much. So how does that come into play when you're looking at the research that you do?
Well, commodities prices are very important for a variety of issues, as you were just implying. First off, because they represent a substitution investment. Investors could say, do I want stocks? Do I want bonds? Do I want real estate? Do I want commodities? Because these are elements that make up a diversified portfolio. And if you want to outperform your benchmark, you overweight one area where you think that growth is going to exceed the long-term average, and you underweight another area. The other reason why commodities are important is because which commodities are doing well. Oil. Oil is such an important part of our U.S. economy, global economy, in fact, that there's an old rule of thumb that for every $10 decrease in the price of oil, it adds about 20 basis points, or 0.2, to economic growth over the coming years. So a decline in oil prices tends to point to an increase in economic growth because, hey, if it costs less to buy that commodity to help fuel your factories, well, then you have more profits and more economic growth that can be a result overall. We also find that if commodity prices are down, so too is inflation. And inflation is very important because inflation and interest rates tend to go hand in hand.
Right.
And so the lower interest rates are, the more attractively valued stocks can be. Also, when inflation is low, see, what amazes me today is everybody is talking about, oh my gosh, PE ratios are 40 times as expensive as they have been since 1946, so it's time to bail out of stocks. Well, not really. If you remember the movie Raiders of the Lost Ark, the reason the Nazis were digging in the wrong spot is because they only had one half. They only had one side of that medallion that told them where to dig. The other side was also important, and the same is true when looking at stock valuations. Yes, PEs are important, but so is inflation. Mm-hmm. The reason we had a bull market end in 1981 when PEs were below 10 is because inflation was at 14. Today, inflation is below 2, so therefore we can afford a higher PE ratio. We're actually in the lowest quintile, the lowest 20%, as I said earlier, of inflation since World War II, and that traditionally has been very supportive of stock prices and PE ratios.
Yeah, it's a great point. Certainly inflation is such a key area, and all the central banks are struggling to reach their 2% targets, and it doesn't seem like we're going to get there anytime soon. And to that end, you made you used the simile of going out. Why would traders go out into the ocean when it's calm, right? I guess that's more of a metaphor than a simile, when there's no volatility. So I wondered what your thought was on the VIX, because this is a continuing theme in the market narrative out there, that things are calm, that economic surprises are not really occurring, that we're not seeing these jolts like we used to do in the 80s with inflation at 14% and then interest rates at 20% and that kind of thing. Does that kind of form your view on why VIX is so low?
Yes, it does, mainly because there are not a lot of things out there that are going to cause the markets to panic. People are always questioning, well, gee, the news that's coming out of Washington, the dysfunction that appears to be emanating from that area, people think, oh, isn't that going to put pressure on stock prices? Well, no, I find that politics makes for good headlines, but it's the expectations for the economy that makes for bottom lines. And so really the question is, are we headed for recession? Essentially, 2 out of every 3 bear markets has preceded or accompanied the start of a recession. And the other bear markets were basically the result of investors acting like hyperactive first graders playing musical chairs, always trying to out-anticipate the other as to whether a recession would be occurring. So I think that the low volatility that we're experiencing now is just because there are not a lot of things that investors are fearing. And history says, again, that you really should not be abandoning the market just because there is low volatility. Since World War II, we have had 17 times in which the market experienced above average all-time highs, but below average times in which the market was up or down by 1% or more in a single day. And in all 17 times, the market was up for that calendar year, and it was up by an average of more than 19%. Mm-hmm. 2 caveats. One is past performance is no guarantee.
I was just thinking that. I'm like, for the audience, Sam is talking historically here, and again, past performance does not mean that you're going to get the same thing in the future, essentially. So good. Right. I'm glad that you said that.
And caveat number 2 is this year's not out yet.
Right.
So yes, we've had incredibly low volatility,
right,
and an awful lot of new highs. And so, don't assume that this market is just going to roll over and die anytime soon. But at the same time, don't take your eye off the ball.
All right. So, speaking of rolling over and dying, before I let you go, let's peer into the future a little bit. And I have to ask you, what are the top things that would change your U.S. or global outlook? In other words, what are the top 3 things that could make us roll over and die?
If we find that the economy is actually losing steam, one of my favorite indicators is housing starts. Every recession since 1960 was preceded by as little as a 10% year-on-year decline in housing starts and as much as a 37% decline. We currently are up about 2% year-on-year with the most recent housing start reading. So to me, that's actually a pretty positive indicator. Okay. I also look at consumer sentiment, and I look at the yield curve, or the difference between interest rates on the 10-year note and interest rates on the 1-year bill. All 3 of these indicators are giving me the thumbs up.
Okay.
But if they were to erode, then that could end up being a problem and signal the potential of a recession. We don't need a recession, however, to go through a 5 or 10+% decline. That could occur from the jolting of our confidence. That could occur from a natural disaster. That could occur from a geopolitical event. Maybe it occurs if we find out that there's not going to be any kind of tax reform or tax cut coming from Washington, that maybe that upends investors in the near term by throwing us into a pullback or a mild correction, but I don't think it'll throw us into a bear market. And as a result, I think that investors, if that occurs, should be thinking about buying, not bailing, because I am continuously amazed with the speed with which the market gets back to break even following declines of 5 up to as much as 20%.
Sam Stovall, Chief Market Strategist at CFR. Thanks for coming on the show today.
Andy, always a pleasure. Look forward to talking to you again soon.
All right, great. Hey, that's it for me this week. Again, you can subscribe to the podcast by going on iTunes and searching for CFTC Talks, or you can listen to the podcast by going to our website, cftc.gov, and click on the podcast button. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening. But wait, there's more. Disclaimer time! The CFTC is providing this information as a public service and is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in the podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provided similar services to those of the guests. The views and opinions expressed by the guest in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to the accuracy and relevance of the information incorporated and referenced in this podcast and assume the entire risk related to its use. The CFTC is providing this interpretation of market trends solely to inform the public of a framework for projecting future outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult with an attorney.